What's up, everybody? Welcome back to the Stock Trades YouTube channel. It has been forever since we put out a new video, but we are proud to say that we are going to be back on the channel in full force in 2021 with weekly videos on some of the best opportunities in the country. If you haven't been to the channel before, my name is Dan Kent. I'm one of the co-founders of Stock Trades and one of the founding partners of Stock Trades Premium. So for the video this week, we're going to kick off 2022 in the right way, and I'm going to go over 5 reasons why you simply cannot afford to be sitting on the sidelines when it comes to investing, and why it is absolutely critical to be investing moving forward. So with that being said, let's hop right into the video and get started. So just quick before we get started, subscribe to the channel if you want great Canadian investment content. And if you want to see much more of our content, you can head over to Twitter and give Matt and I a follow. I'll throw our Twitter handles on the screen. You can also like us on Facebook if you want. And as always, stocktrades.ca is one of Canada's largest investment sites for Canadian specific research. So the topic of this video, why you simply cannot afford to not be investing moving forward. A lot of people have been emailing us, chatting with us. They're scared to get into the market right now because it's overvalued. It's, doomed to crash because of current valuations. But the fact of the matter is the market has been overvalued for years now. But if you've been sitting on the sidelines for the last 1 year, 3 year, 5 year, 10-year periods, you have underperformed and missed out on some life-changing returns. So there is an argument to be made that you should simply buy strong companies and hold them for the long term. Valuation does come into play, and it should come into play during your research, but simply hoarding cash due to the fact you feel the markets are overvalued, there's going to be 2 results from this. You're either going to miss out on more returns, or you're simply going to get lucky, because that is essentially what you need to do to be able to time a market crash. So the first reason why you absolutely need to be invested in the stock market in 2022 and beyond is inflation. If we look to the stock market's results over the last 50 years, every $1 invested in the stock market has turned into $177.33. This is some staggering amount of returns, especially over the course of, half of a lifetime. This works out to be just shy of an 11% return every year on average. Now, this is where it gets very interesting. If we remove inflation, those returns shrink to $27.12. This looks relatively small, especially when we compare it to the prior number of $177.33. And this is ultimately the impact of inflation. If you've ever heard of somebody saying, wow, this costs XX amount of dollars in my day, and now it costs this much more, they've been impacted by inflation. And Warren Buffett, actually one of the most famous investors of all time, refers to inflation as a giant corporate tapeworm. It consumes investment dollars regardless of the quality of the company. And the only ones that are going to be successful over the long term are those with pricing power and the ability to outpace inflation. Now, in terms of an investor, that means you need to be investing in companies that are set up to weather inflation. Now, what kind of companies those are a topic for a different video. But for now, let's just get back on topic on how inflation can really deteriorate your portfolio. So you actually might think your wealth is growing by hoarding money in a savings account, but the reality is it is shrinking. So the Consumer Price Index is a measure of how much it would cost a Canadian for an average basket of goods and services. So imagine going to the grocery store in the year 2000 and buying $100 worth of groceries. That same basket of groceries will cost you $150 today. That is a 50% increase. So let's also say in the year 2000, you had $50,000 in a savings account. Over the years, you managed to grow that account up to $75,000. Although the dollar value of your account has grown by $25,000, considering everything costs 50% more, you have in essence saved nothing. So what exactly is the solution to this? Well, for the most part, historically, it has been investing in stocks. The average dividend growth of the stock market is just over 5% annually. This doesn't include capital appreciation, but this is simply just the dividend growth of the companies. And over that same amount of time period, that dividend growth has shown to outpace inflation. So even if we were to enter a bear market, if you own strong companies that maintain their dividends and grow their dividends at a faster rate than inflation, you will ultimately be increasing your long-term buying power. So ultimately, we want to create an investment portfolio that grows faster than inflation. And to show you an example of how important this is, say we go back to the above situation and you had invested that $50,000 and earned 8% a year. Whether half of that be from dividends and half from capital appreciation, or the most of it from dividends and nothing from capital appreciation, you would have a total balance of $233,047 today. So although inflation has resulted in a 50% increase in the cost of goods, your investment has increased in value by nearly 500%. This outpaces inflation by a significant margin and ensures that the buying power of your hard-earned dollars does not deteriorate. So this is quite possibly the most important reason you need to be investing today. But with that being said, let's move on to number 2, which is quite possibly why most people do invest in the first place, and that is retiring earlier. So I think no matter how much we all love our jobs, ultimately we would retire earlier if we had the choice and we had the capital to do so. And the thing is, the earlier you start to invest, the earlier you can retire, because a dollar invested now compounding over time can turn into a ton of money over a 30 to 40 year time period, and you can start doing things you really enjoy over heading to that 9 to 5 every single day. So let's head to the screen here and I'll show you some pretty basic examples of how getting started early and contributing consistently can end up in you taking years off of your retirement. So if we make a relatively conservative estimate of 1.5 million needed to retire, it would be virtually impossible for somebody on a modest income of $60,000 a year after tax to achieve this over a 40-year working career if they were simply saving their money. So even putting 1/3 of their income aside would only result in $800,000 in savings after the 40-year mark. But if that person had decided to invest that $20,000 every year and earned 8%, their $800,000 in total contributions over the course of that 40 years would result in a whopping balance of $5.6 million. And even if you were to structure an income-based portfolio that generated you 3.5% every year, that's $196,000 just in dividends. And that is nearly 4 times your retirement goal. In fact, you would have hit your retirement goal of $1.5 million just 25 years after you started investing. Now, these numbers are pretty high. Not everybody has $20,000 in disposable income to save every year. But the fact is, whether it's $50 a week, $50 a month, every single penny you invest now ultimately leads you to retiring earlier and doing the things you enjoy. But that one's pretty self-explanatory. Let's move on to the number 3 reason why you need to be investing in 2022 and beyond, and that is tax sheltering your capital. So everybody hates paying taxes. If you don't, I'd probably call you crazy. And over the course of our lifetimes, we want to end up paying as little as we possibly can to the government. And the government does set up a couple critical investment vehicles for us to be able to do this over our working careers. And in terms of one of them, throughout our entire lifetime. So the first one is the tax-free savings account, and that is the one that essentially will run the duration of your life. You will always be able to collect tax-free income and tax-free gains inside of this account, and the RSP is a very important one to utilize over your working career. Eventually they do make you draw down on it, but again, that is a topic for another video. So it is a huge disservice to yourself to not be utilizing these tax-free investment accounts over the course of your career. Why is that? Well, if we look at a very simple example of what exactly the TFSA can do for you, if we just simply assume that the TFSA contribution will never increase, which is not going to be the case, but that would actually push the results of this up, not down. Contributing $6,000 a year to your TFSA and earning 8% a year on that capital would have you sitting with $745,000 in tax-free capital after 30 years. Not only would that $745,000 be earned tax-free, but the dividends you earned from it, the interest if you choose to hold fixed income, and the capital gains inside of it are completely 100% tax-free. The government does a pretty big disservice to Canadians by labeling this the tax-free savings account. It should be labeled the tax-free investing account, because simply putting money in there and saving it is a pretty big error. You need to be investing in this account. It is absolutely critical. And the RSP, on the other hand, will allow you to not only claim tax deductions, which the benefits of that are highly dependent on your income, but it will also allow you to receive tax-free dividends on Canadian and US dividend stocks, which is not the case in the TFSA with US stocks, but it will also allow you to earn tax-free interest income and tax-free capital gains until the money is withdrawn. Now, strategically, you would hope in retirement that you're in the lowest possible tax bracket, but that is depending on your personal situation. But overall, the RSP is going to be an outstanding account for you to compound your wealth tax-free as well. So the number 3 reason you need to be investing today: to tax shelter your investment gains and vault your net worth. Number 4 on this list is kind of a defensive stance, and that is the diversification of your income. So don't get me wrong on this reason. You should be deploying a long-term buy and hold strategy when it comes to your investments. But if you aren't investing right now, it is very likely you have one source of income, and that only source of income is your current employment. If you were to lose this employment, you would likely be in a position where you have no money coming in. And with a well-structured investment portfolio, that can change. So although you should be leaving your investments alone and letting them compound and grow, if absolute push comes to shove and you do get in some sort of employment trouble or absolutely need the money, you can easily divert some streams of income, and you aren't solely depending on your employer to provide you with enough food to feed your family and pay your mortgage. Now, on to our 5th and final reason, and that is achieving financial independence. So for the vast majority of people, this will be the number 1 reason that they will start to invest and continue to invest moving forward. And a lot of people actually might be confused with point number 2 and point number 5. Point number 2 being retiring earlier. They might be asking, well, what exactly is the difference between achieving financial independence and retiring earlier? And the number 1 difference between being financially independent and retiring is the fact that you can still work while being financially independent. By definition, being financially independent is essentially having enough income from your investment portfolio, whether it be from capital gains or dividends, to cover all your living expenses. You can still continue to work, but you're simply choosing to work. You aren't being forced to work. At any time, you could quit your job. Your dividend income inside of your portfolio or your capital gains would pay your bills, and you could sit on a beach somewhere. Many people who are financially independent choose to continue to work. And whether that's because they truly enjoy their job, they're trying to save wealth for their children inheritance-wise, or they simply just want to collect more money, the whole idea for them right now is that they are choosing to work. They are not being forced to work. So ultimately, probably one of the biggest reasons you need to be investing in 2022 and beyond is to achieve that ultimate goal of financial independence. What you choose to do after that is completely up to you. So everybody, wrapping it all up, the gist of it is you simply cannot afford to not be investing in 2022 and beyond. Investing often gets correlated exclusively with the stock market, but the fact is you don't need to put all your money in the stock market to invest. There are a ton of products. You can buy bonds, you can buy segregated funds, you can buy GICs, you can buy real estate, you can buy REITs. Even though they trade on the stock market, they are a completely different investment vehicle. You can buy ETFs, you can buy broad-based index funds, you can buy mutual funds. There are way too many options to simply sit in cash. Now, you might have to use a financial planner, a financial advisor, or you could go out and do it on your own. But the fact of the matter is, there has been extensive studies done that have shown even if you invested at the absolute market peaks, over the long term, you have still outpaced inflation, which is, as you can recall, our number one reason why you need to be investing moving forward. So fearing the market highs and having the obsession of having to buy something that's on sale, buy stocks when they fall, buy the dip, this is a big mental error that a lot of investors have to get over. And the reality of it is, over the short term, even though during a big drawdown or a long bear market, it absolutely sucks. If you have your portfolio set up, it's diversified enough, you have it set up to your risk tolerance, you have the right products in there, the right stocks in there, you will essentially, over the long term, reduce your risk to zero. So I hope this video really helped you out. If you're investing in the stock market right now, I hope it gives you a little more motivation. Or if you're just looking to start out right now, I really hope it helps you get over those hurdles, those fears of getting started. And you can get started contributing money to an investment account today and compound your wealth significantly. Stay tuned for more great videos, everybody. We got a ton of stock research. We got a ton of how-tos, a ton of informational videos like this that you are not going to want to miss out. And we will officially be back on the YouTube in full force in 2022. Like the video, subscribe to the channel, follow us on Twitter, and we'll see you next time.